Thank you for joining us. I'm Gord Long. As always, it's my pleasure to have back with me today Charles Hugh Smith, well-followed and prolific writer on the web. Time, once again, Charles, to exchange some ideas, which I always look forward to. Any key themes in your recent writings that you want to share with our listeners before we start on today's topic?
Well, thank you, Gordon. Yeah, I've been writing a lot about moral hazard, the disconnect of consequence from risk, and I think that's a key factor in the global economy.
One of the key points we're going to bring out here today. Charles, as I normally do, I need to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing the important trends that we're identifying and simply make our discussions available to the public for those that might be interested or want to contribute comments, which we truly welcome. Today our talk is a natural follow-on from a significant amount of writings we both have been doing on China, as well as videos and newsletters on the topic from MATA SII. What we want to do is to crystallize the salient conclusions we have both arrived at through independent and completely separate analysis. I'm showing here the agenda. We hope to cover in the following what I believe are unique, approximately 45 slides. So we'll go through quite a number of them quickly, but allow you to go back at your own pace or leisure and examine them. Any comments overall, Charles, before we begin?
Yeah, thank you, Gordon. I want to kind of set the context of our discussion here on China. I want to stress that we're not claiming to be experts. In other words, at the level where we're reading Chinese military documents in Mandarin and that kind of thing. We are close observers of China. And I can personally attest to having studied it academically, having visited, and having a lot of Chinese friends. And who, if they trust you, they will tell you things that you're not going to read in any media, because they're not going to tell you if they think it's going to end up in the media. So we're close observers of China, and I want to make a few quick points about China that for listeners who may not have expertise in the subject. Is China is not the West. And so so many people approach China with a Western perspective, and then that's going to mislead them. China has a unique history of being a dominant global culture, for thousands of years. And so there's a lot of national pride. And there's also a very deep scar from the humiliations that China suffered in the 19th and 20th centuries, being subjugated by the West. These are real issues today. These are not just history that's in a dusty book somewhere. These are live, pressing issues in the Chinese culture. President Xi, who we're discussing today, he is not a technocrat like his predecessors. He's a visionary. He has a vision, and that's part of what we're talking about today. Is what his vision is and where he may go with it. I also want to mention that President Xi has personal experience of the Cultural Revolution, which was roughly 1966 to 76, and which was extremely traumatic in China's history. And there's no parallel in the Western world in the last 50 years. So he's looking at China today with a memory of what happened in the Cultural Revolution, which was devastating. And so that's kind of the context I want to start with. So please take it away.
So let's start with the key points that we'll actually focus on in that context in these slides. The 2008 financial crisis was a seminal event on a number of fronts, one of which was the emerging importance of the Chinese economy to the global economy. And China's dramatic increase in credit, as represented by what is referred to as the Chinese credit impulse, and shown here over the last more than a decade now, was a key driver in actually rescuing the global economy from the fallout from the U.S. mortgage debacle in 2008. What has transpired over the last 13 years is that China has been forced to do this 3 more times, as much to protect its own economy as, in fact, to assist the rest of the world. The problems never stemmed from China, but China was forced to react, whether it wanted to or not. And clearly the global economy faces serious problems ahead. If you've been listening to any of the work that Charles and I have been doing in these videos, markets don't react like this in a sound economic environment. This chart I'm showing here with the rise in the S&P. Who knows when the next crisis will occur? Only that this chart certainly says that it will, and our underpinnings and the things we've talked about says why. So the question is, will China save the global economy again? And maybe the real question is, can Xi actually save China itself, ever mind the global economy? And maybe expanded credit isn't the solution this time, which it has been, and maybe China will be possibly the catalyst itself for the next crisis. These are the kinds of things we want to focus on. China's growth model is in crisis. And Charles, maybe you want to take us through these three key points here.
Thank you, Gordon. China's growth model since Deng Xiaoping's opening up of their economy in the late 70s and early 80s has been two things. One, the export industry, right? We all know manufacturing products to ship globally, and property development. And the property development model is now failing. And there's lots of evidence of this with Evergrande and various things. And the reason why it's failing is often misunderstood in the West, and we'll dig into this a little later. But the basic idea is the only way that local governments can fund their own operations is to sell the development rights to property in their area. And so property development is the only source of funding for the local governments, and so that's why they have to do it. Whether the buildings that are being made are constructed are needed or useful is secondary, and so this has created a massive amount of malinvestment, which there's some evidence that you can see on the web of ghost cities and empty high rises and this kind of thing. So that's something that China's leadership has to deal with, that the property investment model that's worked for 40 years is now broken.
I think it's important to view the Chinese problem as both structural and systemic. And as this slide attempts to illustrate, there are structural problems at the country and then at the regional and at the individual levels that are all interconnected and built on each other and the Chinese investment model itself. And the massive credit expansions China undertook on these four separate occasions I just mentioned over the last decade only exacerbated this and accelerated what is referred to as a moral hazard. It is forcing Xi into a hard shift, in both Charles and my opinion, to prepare for what he sees needs to be done in preparation. He needs to realign the Chinese culture to reduce its dependencies on its current investment model. And there are two central problems here: moral hazard and inequality. Charles, you want to expand on those? Because you've written extensively about both of these in China.
It's interesting, Gordon, is that these are core to China's problems. And I like the way that in your slide on the structural and systemic that you mentioned the cultural value of real estate. And many of our viewers have probably seen the chart that shows that in terms of household wealth, real estate is by a great measure, the dominant source of savings and wealth in households compared to, say, the U.S. or Europe. So that's a cultural value, that property is wealth. And so if the property bubble pops, that's going to have a tremendous impact on household wealth. In terms of moral hazard and inequality, what I find amazing is that these are the same two problems that the United States has. That, the big gambling, the speculators have been bailed out, the banking sector has been bailed out, so that's moral hazard writ large. And then wages have stagnated for 45 years while capital has feasted on tens of trillions of dollars of gains. So that inequality is the same issue we have. And what happens in both China and the U.S. is if you basically starve the workforce, the labor force of the gains of the economy, they don't have enough money to support consumption. And that's one of the key issues in China is a lot of people look at the Chinese economy and they go, well, it's grown by leaps and bounds. And how come so many, how come the wages are still suppressed for many people? And we need to make a quick distinction here between the developed East, the coastal China, where there's hundreds of millions of people in the middle class who have bought everything. They have cars and investment flats and all of the electronics. They don't really need anything else. But the less developed West, where there's still hundreds of millions of people earning a few $100s or a few $1,000s a year, and they don't have enough income to support a consumer economy. So my last point is here, as you point here, money flows and corruption. When you have these huge concentrations of credit and in the property development sector, then you're naturally going to create corruption. So there's this immense source of corruption that's systemic between the local leaders who are selling the development rights and the developers. And so it's, hand in glove. And so this is part of what President Xi has been trying to limit, but the system creates corruption. You can't just attribute it to some personal weakness. It's like the system itself generates that corruption.
China is a direct result of what problems we've had: global financialization and expansion of creditism, and these things have flowed over into a moral hazard and resulted in inequality around the world. And China is no different than the rest, just a whole different way of how it's being translated as part of their culture. Same kind of issues, though. So what has Xi done exactly so far in his redefining what they used to call Chinese capitalism to what now he regularly refers to, every time I see anything, as Chinese socialism, or his most recent terminology is common prosperity? A little background here may be helpful in explaining the shift that we are actually now witnessing. When Xi assumed power in 2013, he followed the Chinese reforms of what was termed as, they called it capitalism with Chinese characteristics. You remember this, right, Charles? And it's okay to get rich as long as the country prospers. But his first speech, to me, really signaled the problems few fully appreciated at the time. And that he was very critical of the Soviet Union for being so soft on perestroika, and was actually quite specific when he said, and I quote, they should have crushed it when they had the chance. Then he specifically set up an institute to actually study the Soviet Union's collapse to see what he could learn from it. An institute. And that should have been a clear red flag that he was going to be much more of a hard liner than people were envisaging at the time, as we just flooded in because China was a capitalist country. It was at that time, but it is shifting very, very quickly. And he was hard when he came in on anti-corruption, which the West loved, but beneath it he purged political rivals, he clamped down on emerging freedoms, and he increased state surveillance and censorship through China's new massive social credit system, which, Charles, I recall a couple of years ago, we did a complete video just on it when he was rolling it out. It was about do what you want as long as you don't question the party and you do what the party wants done. And in 2008, he was actually made president for life. And in 2019, he then started, in my opinion, to really switch. He started going after celebrities like Jack Ma, the co-founder of Alibaba. He started taking a much harder line on the flowers of capitalism, if you will, than the past Chinese president. He had party officials make his views the platform of the party itself in the approval of his Xi Jinping's thought on socialism with Chinese characteristics for the new era. It was profoundly, it's like Chairman Mao's little red book. And we have now seen leading globalists actually now turn against him in the strongest terms possible. The most vocal probably being George Soros, when he publicly said, amongst other things, and I quote here, a number of quotes I'm showing, but the one that really brought it home was, quote, I consider Mr. Xi the most dangerous enemy of open societies in the world. The Chinese people as a whole are among his victims. but domestic political opponents and religious and ethnic minorities suffer from his persecutions much more. That's the strongest kind of language. And as Soros is a representative of the Davos crowd and as a globalist, they were 10 years ago absolutely flat out endorsing investment in China. That's how profound and worried that crowd now is. Charles, you have some views here. What are you seeing?
What's interesting and confusing to people in the West as a generality, I think, is that China is integral to the global economy now, right? And not just in manufacturing, but in, as you say, the credit and currency and many other elements. And yet it's also separate. It is still separate, and we'll talk about that more. So it's both integral, but it's also not completely part of the West and part of the global economy. And so it's interesting to me that, as you pointed out, he's referring to issues that were part of the Mao Zedong era of China's history. In other words, socialism as opposed to capitalism. And I liked your use of the word that it was actually puritanical. In other words, that he's trying to guide the cultural evolution of China back toward common prosperity, socialism, the values that Mao espoused in the 60s and 70s. And so he's clearly setting the stage for a major change. This is what we're trying to say.
So what does Z see? What is really driving his shift now, as best we can determine? So let's quickly look at some current economic charts that I've got here. Chinese manufacturing has been steadily slowing and has now went negative, despite a major global rebound since we reacted to COVID. As the global factory and manufacturer for the world, this is not good for the world, nor the 1.4 billion Chinese workers. The Chinese home sales and property sector shown here is seriously hurting, as the fallout from the Evergrande just continues to unfold. Over 25% of the Chinese economy is centered here, as Charles was mentioning earlier. To put it in perspective, it is the biggest single asset sector in the world. For those that don't appreciate how big this has gotten. So China's high yield rates, as shown here, are off the charts, though they have improved slightly as he's been forced to begin possibly, and I think he has, reversing his credit tightening stance once again for possibly the fifth time. So credit has been intentionally weak by his policies, but is showing signs of possibly bottoming as his initial policy reversal to stem these problems in real estate and manufacturing are coming to the fore. So the Chinese problems have become a major drag on the global economy, as shown here. You need to fully appreciate that the Chinese credit impulse has consistently led the U.S. economy, a Western economy, by approximately 12 months since the 2008 financial crisis, every single time. And that 12-month is we're right on it right now because of the lag. The Western economies are now reaching the 12-month delay of when China severely began tightening, as shown here after the initial COVID-19 shock. We are likely about to face the tsunami effect of this very soon, if frankly we're not already there. So what does Z see? He sees China export sector has stagnated, is now in decline. China's debt has exploded to 350% of GDP, but much of it is in decaying empty flats with no resale value. Property development is the only game in town, but prior malinvestment has diminished returns, and there is a current desperation of wealthy Chinese to get their wealth and family out of China. And Charles, any comments here? I know you've an example of that firsthand.
Yeah, I think that we have to look at the diminishing returns, not just on property development, but also on credit. In other words, expanding credit when everybody already has everything. It doesn't have the same benefit in terms of boosting your economy. And so that's when we talk about malinvestment. It's the diminishing returns on credit. So I think one of the things we have to look at is when economies try to restart growth by creating another tsunami of credit, it works less and less well, right? It does less for the real economy, and it actually just generates more, speculative bubbles. I use the number of 350% of GDP. Many numbers are lower, but I think that it's everyone's guessing about the shadow banking system because a huge amount of capital and credit exists in China that is completely outside the banking sector and outside the government restrictions. So in terms of getting your wealth out of China, it's of course well known that many wealthy Chinese have immigrated to Canada and Australia in particular, and also the U.S. And I think that this is has to be interpreted as there's an understanding in the wealthy class that their wealth may not be permanent in China, and so they if they want to keep it, they're going to have to move it outside of China.
Exactly, Charles. So the question is, what is he likely to do? And maybe most importantly is, what can he realistically achieve? And I wonder, Charles, you could just take us through this little section for us.
The elements that we need to focus on in China's economy are credit, which we've looked at, property, right, the wealth, consumption, which is based on income, right? You can only consume what you earn, and then the declining export sector. So we've covered those things, but let's focus on wealth and income inequality. And so China, like the U.S., has soaring wealth income inequality. That they have a billionaire class, and then they have an upper middle class who is buying second and third investment flats, right, which are left empty because if you rent your flat, you lower the value. Nobody wants to buy a used apartment; they want a new apartment. But if the place is not, if it's not maintained and not lived in, then of course it starts falling apart. And so this is just a practical matter of the real world. Like if you don't use things, then they start breaking down and they start leaking. And then so putting all your money into apartment buildings that no one lives in is not really that's diminishing returns too. It's not really building an economy in which people are improving their well-being, right? So President Xi's talk about common prosperity is just propaganda unless he can radically redistribute capital and income from the private sector elites and the Communist Party elites to the bottom, say 80 or 90%, whose wages have stagnated in China as well. So how do you do that without impacting the elites? And this is a real problem for President Xi, just like it is for leaders in the West. And even though President Xi has tremendous power, it's not absolute. And we can see this when he proposed property taxes, because China doesn't really have a property tax system like we do, where people pay a significant amount of money in property taxes to support their local government and schools and so on. So he wanted to institute this because he sees the problem is you've got to be able to fund your local government with something other than development fees. Well, he got huge pushback because the system is set up to benefit from corruption and property development, and so people don't want to pay a property tax. Well, but if you don't pay a property tax, then you can't fund local government. And so this is just an example of how it's very hard to change the system once it's been in place and there's an elite that's benefiting from it. And of course, that's the same problem we have in the US. The elite that's benefiting from the current system, which is totally distorted and unsustainable, doesn't want it to change. And so President Xi has the same problem.
So what is the likely outcome here? And it's my view that it's going to come down to Xi's ability to effectively adjust and control the Chinese credit throttle going forward while maintaining social control. during what is going to be, no doubt, a very difficult time for China and the world. So let's look at the hard economic realities, okay, no matter what he wants to do, of why I sense this is actually going to be the case. When you examine China's rapidly growing total debt to GDP, it still has a fair ways to go to even reach the U.S.'s current level. China's debt is only 75% as large as the U.S.'s, which means it could increase its debt by 1/3 relative to the U.S. before matching even the current U.S. level, a U.S. level that is currently expanding by fiscal slugs of $1 trillion and more a pop. So China's government debt, shown here as a percentage of GDP, is also only at 92% compared to 113% for the U.S. And you have to remember, in the U.S.'s case, the 113% doesn't include major unfunded liabilities, which are larger than the current fiscal deficit, and additionally what is known as the fiscal gap, which accounts for contingent liabilities the U.S. is obligated to, which are reported to be in the area of $212 trillion. So, but China has none of this, has none of these obligations or fiscal burdens to deal with. And by the way, I don't trust the Chinese numbers, so I think it's even higher. But still, the magnitude says they've got lots of room to move here. If China follows the Japanese, which had the mercantile strategy and had a housing or real estate of monumental proportions and how they had to adjust for it before it faced a multi-decade stagnation, it is still a long ways from even Japan's current 254% level. So all this suggests that more debt and credit growth, if inflation can be controlled with a hard-fisted hand, is likely the recourse for Xi. It will be about controlling that credit throttle, in my opinion. As I mentioned earlier, there are already signs China is taking its foot off the credit brake. I suspect, as this chart on the right at least suggests, we will see yet another major can-kicking for China's property sector at the expense of trillions in new debt. This time, however, it's going to be different because he clearly knows it's got to change, and it's going to be highly likely to be targeted specifically at the local government level, who, as you said earlier, Charles, the only way they can fund themselves is by selling property because they can't implement property taxes. And he knows he can't get that in place, so he's got to pass money directly to them, and that's where this new spigot is going to be targeted to keep the system afloat going forward. Xi is facing the realities, as I show here, of what is, that's one of the reasons brought me to this conclusion, of what is referred to as the Mandell-Fleming trilemma. And in a nutshell here, and it's an academic kind of concept, but it truly does work. In the world of high capital mobility, which we have, a central bank can either target the exchange rate or it can target the interest rate, but they can't target both. Additionally, a country must choose between either one, free capital mobility, an exchange rate management, or monetary autonomy. Only two of the three are possible. You can't get all three. You have to give up on one. And so, as this slide shows here, you got a country that wants to fix the value of its currency and have interest rate policy that is free from outside influences can allow capital to flow freely across its borders. Or, if the exchange rate is fixed, but the country is open to cross-border capital flows, it can't have an independent monetary policy. And, thirdly, if a country chooses free capital mobility and wants monetary autonomy, it has to allow its currency to float. And this is why the CCP has been strengthening its capital controls and is cracking down on money fleeing the country. The problem is, when your country is the #1 trading partner with over 100 countries, there's a lot of capital holes to try and plug. It's almost impossible. It's nearly and totally impossible, frankly. So over the last 18 months alone, credit in China has grown by 6.5 trillion, while deposits have increased by less than half of that. So China has to fund enormous moves in credit growth just to keep in roughly the same place. We call it running by standing still. All it'll take is a catalyst, and these banks will go bust in China and will need to be recapitalized. The same as we saw in Japan, which we didn't do. This means, frankly, just simply printing a lot more money, which will result in, and this is the bottom line, a much depreciated yuan or renminbi. And that actually always was what China wants, because they want stability, but a lower currency continues to make their products more attractive. And they have some serious margin problems right now. In maintaining their margins are being squeezed here, so they got to keep those volumes up, and a depreciating one would help. I didn't say that was imminent. I think that's a natural consequence, is what I'm trying to suggest. What are your conclusions, Charles?
I'm really happy you brought up this topic and introduced those slides, Gordon, because this is one of the key points that I see a lot of people do not understand about China's economy. And as I said earlier, it is both integral to the global economy and separate. And what they're trying to do, and you're pointing out that you can't really square the circle here, is China wants to control the value of its currency and by itself, and it wants to set its own interest rates, and yet it also wants to have capital flows in and out of China, and so you can't have it both ways. If you want to have a major global currency, what we call a reserve currency, which currently it's the U.S. dollar is the dominant one, about 60%, the euro, and a very minor role for the Japanese yen and the Chinese renminbi. If they want to open their economy to actually get the benefits of capital flows and a floating currency, they lose control of the value of their currency to some degree, and also the interest rates, that a measure of risk in owning Chinese currency and bonds. So you can't have it both ways, and so they're struggling to square that circle, and it's not possible. So if they want to advance, they're going to have to break the peg of the yuan to the U.S. dollar and let it float freely, and let the global market discover the price and the risk of Chinese currency and Chinese government bonds. If they can't do that, then their currency will always have an extremely limited role in the global economy, and their government bonds will have an extremely limited play as well. So that's why, as I say, you can't look at China and try to say, well, they should follow the Western model. They're trying to follow the Western model where they see it as beneficial, but there is no miracle answer here. You know that's the point we're making. Is if you want a globalized economy, then you have to let your currency and bonds float freely in the global market. If you're going to control it, then you're always going to be a bit player. So you can't have it both ways.
I've come out of the same hole, Charles, independently, because they've always tried to stop currency making the products more costly. I think the new problem, and it will be forced to be free floating to the best degree that they can, but this time, though, it'll be a devaluing yuan that I think will be the issue, as the true risk is priced in as the global manufacturer, and as the global economy really starts to get into contraction as it tries to absorb this massive debt problem that we have. We'll see. So, but he has to accomplish structural reforms, major structural reforms, and we're showing 5 here. Do you want to take us through them, Charles? Because they were kind of your conclusions on the structural reforms.
Yeah, thank you, Gordon. In my view, I think President Xi has to do 5 things if he's really going to change China's economy to a sustainable path. He has to rebalance the wealth inequality, which is going to come at the expense of China's elite. And he has to allow the renminbi and Chinese government bonds to float freely, as we discussed. He has to end China's massive dependence on malinvestment in real estate development. In other words, he has to develop a new sector, a new growth sector in the economy. he has to end moral hazard. The idea that the central government will bail out all the private sector speculators who end up losing money, right? Because that just encourages more speculation. If you know the government's got your back and will bail you out, then you take greater and greater risks until the entire economy is exposed to systemic risk. And that's where China's shares the same problem as the U.S. And then lastly, to create a new source of economic expansion that isn't dependent on exports, real estate development, or skyrocketing debt. Those are not sustainable sources of economic growth, as we've often mentioned.
Charles, in our previous macroanalytic videos, we've laid out very detailed on why COVID has triggered or will trigger the next financial crisis. And that the crisis is not likely imminent, but now inevitable and unavoidable. We just don't know when. And it is long overdue, and frankly will be healthy and required for future generations. That's just the fact. So this is going to happen, and we'll see whether Xi is successful and to what degree and exactly how it unfolds. But there's a strong probability that we're closer to being right than being totally wrong here. China's likely not to save the world this time, but it may save itself from the severity of just escaping from the self-inflicted systemic and structural problems it has created for itself. And I think that is where he'll probably be the most successful. General Charles, money always flows to where it is treated best. And if China can continue to pay the best inflation-adjusted returns, well, understanding the currency is going to be a problem. But at least it's being debased, or less than the world is debasing current fiat currencies in the developed nations, then its capital formation model, properly retargeted, may succeed. And I think that may be the gambit that he can really play through properly. And as you said right at the beginnings, he's a brilliant strategist, and he's a thinker, and he's got the will and the power, and now he's got the total power to make the changes in real time. And even if we're wrong, he can adjust. Whereas in the Western societies right now, we are very evident we're having troubles agreeing on anything. And so rapid change has not been something that we've been particularly good at. So we'll see about that. Of course, it's all relative too. How well he does relative to how well the Western developed world does. Charles, any closing comments you'd like to make here, or any further thoughts?
I'd just like to emphasize one of your last points you just mentioned, which I think is key here, which is China's goal. I think President Xi's goal and the leadership's goal is to save China, not the world economy. And they've bailed out the world economy, as you said, 3 times. And it's sort of like maybe they think that enough is enough. Let's take care of ourselves, and everyone else is going to have to pick up the slack or deal with the consequences. And so I think that's a key point, that everyone looks to China to save the world. And it's like, well, they've done it 3 times. That's they may be correct in recalibrating their agenda to taking care of China first. And to your last point, imagine if China allows its currency to float freely, so the market sets the value of the yuan, and it trades its bonds freely, so the value of the bond and the risk factor can be priced by the market, and you can get a 5% return on your money, and you have the safety of the market pricing. Then you could see that China could be an absolute magnet for global capital if he can make those reforms.
And additionally, as an investor, if you could just hedge the currency, and these kind of rates sustain themselves, where are you going to put your money? Assuming you can get it out, but hedging against the currency risk, and we know that the Western world will be forced to go to even lower real rates of return. Maybe the nominal rates will be positive, but the real rates will be, in my assessment, negative 1.5 and possibly even much higher for a sustained period of time. That's called financial repression. It's a stated way that the Western countries always have of getting out of debt. It will be the same again. And if he can maintain a relative lower inflation rate, but even at these kinds of nominal rates, and you can hedge against the risk of the currency, there's a potential that China, no matter what its problems, may be one of the best investments you can make going forward. I don't know. Time will tell. I'm not giving investment advice, but I can tell you this. We're certainly looking at it seriously. Charles, we're out of time here. Where can our listeners follow your writings and your work?
Yeah, please visit me at of2minds.com. All my archives are free, and you can read sample chapters of my books.
Charles, enjoyed the conversation. Always enjoy it, and we'll talk to you in a month or so. Thank you.
Thank you.